a lot of questions about interest rates and what is going on with them. So that's what we're talking about today.
I keep it real. I keep it real. I keep it real. Just keep it real.
Hey guys, my name's Sam Hartman. I'm keeping it real estate in Northeast Indiana. And every week or so, we like to grab a topic that is kind of prevalent in the real estate industry, something maybe I'm getting a lot of questions about, and do a deeper dive with some data, some context, some quotes from experts in the industry to try to create some clarity and confidence for home buyers and sellers as they try to navigate that real estate experience. Clearly, I always want to be a part of that experience no matter what stage of the process you're at, so make sure you reach out to me if you're in the Northeast Indiana area. But today, we are getting a lot of conversations and topics and questions about what's happening with interest rates. And interest rates are something that aren't just going to affect here my local market in Northeast Indiana, but they're going to affect buyers and sellers all across the country. So what's happening with them? How are things looking right now and going forward? So I'll start with a quote here from Sam Cotter, Chief Economist with Freddie Mac. And you see here at the bottom of this graph as well, we've got kind of the current averages for different mortgage rates and everything right now. The 30-year fixed being the most common at 3.56%. And so Sam, the Chief Economist with Freddie Mac, says, mortgage rates moved up again as the 10-year U.S. Treasury yield rose and financial markets adjust to anticipate changes in the monetary policy that will combat inflation. And so basically what Sam is saying there is that monetary policy is changing. The government has kind of been pumping money into markets to kind of try to stimulate the economy. And now that as interest rates are rising, they're trying to kind of limit that money to kind of slow that against the inflation rate that's been happening recently. So that's kind of what Sam's saying there. That's the monetary policy he's talking about. As a result of higher mortgage rates, purchase demand has modestly waned in advance of the spring home buying season. However, supply remains near historically tight levels and home prices remain high, keeping the market competitive. So lots of good points there by Sam, saying basically with the monetary policy changing, trying to fight inflation a bit, interest rates are going to be rising. And we did a video a few weeks back talking about those interest rate projections, and we'll continue to update those projections as the year goes on. But really what he's saying here is that, is this going to affect home buyers? Modestly. And so it's been a seller's market for a long time, and buyers have been extremely frustrated. So rising interest rates will affect affordability for most buyers, because the higher an interest rate is, the more you're going to pay for the money that it takes to buy a house. And so that can affect your overall affordability. Now changing the affordability, it is going to hurt it a little bit, but housing in the grand scheme with these interest rates, 3.56% is still an extremely low interest rate historically, and we'll look at some of that. So the demand from buyers is still remaining high. Home prices are still projecting 5 years out to be increasing. And I get questions all the time from buyers like, maybe I should wait, maybe we shouldn't dive in, maybe we should wait for, another housing crash. And, ultimately, I think that's a bad idea, because historically housing is a very safe investment. The 2008 and 2009 housing crash was a very rare circumstance. And so the longer you wait, the more you risk paying a higher interest rate, and the more you risk losing out on the appreciation of the real estate market as a whole that's projected to continue to appreciate. So although this is something that's going to be affecting buyers' affordability, it's not necessarily being projected that it's going to extremely affect the real estate market as a whole in the short term here, or anything in the immediate future. And so we'll do another quote from Sam, the Chief Economist with Freddie Mac again here. And Sam here says, as mortgage rates rise, we do expect some moderation in housing demand, causing housing price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. In 2022, we expected purchase originations to grow from 1.9 trillion in 2021 to 2.1 trillion in 2022, which what he's saying there is we're going to have more buyers in 2022, while refinancing activity is anticipated to decrease from 2.7 trillion in 21 to 1.2 trillion in 22. So that last part of the quote, talking about refinances, that makes sense. The interest rates are rising. Most people that were going to refinance kind of jumped in at the historic lows when they were at upper twos, low threes. So as they're rising, there's not as much motivation for current homeowners to necessarily refinance their home. Now, the first part of the quote, though, is extremely interesting because he talks about actually anticipating more buyers coming into the market in 2022, even though we've got these rising mortgage rates. So again, he says that the buyer traffic may moderate and that house price growth may temper. But I think when we talk about those types of words and language that he's using, moderation and temper, these are talking about slowing things down a bit, but not necessarily decreasing. These things are still projected to continue moving forward. The average price appreciation in Allen County, Fort Wayne area was actually over 15% last year. And going forward, we're projecting a more modest, a more tempered 5+% is kind of the projection there. And so even though it's kind of coming down to a more typical level of appreciation, that's still appreciation. You buy a home today and guess what? It's worth more next year. And so that's where we don't want buyers missing out on opportunities to still lock in a competitive interest rate in the grand scheme of things and take advantage of building equity both by paying a mortgage instead of rent, and also the appreciation of the real estate market as well. And here is another great example of these historic interest rates. And I like this bar graph because it shows it in a broader sense by decade. And so these are the average interest rates by decade going back to the 70s. So in the 70s, almost 9%. In the 80s, almost 13%. In the 90s, just over 8%. And in the 2000s, almost 6.3%. And so in the 2010s, we actually were averaging almost 4.1% as an interest rate. And right now, that current rate that we're facing is 3.56. So if we look at history, this is still historically an amazing rate to secure, especially if you're a first-time home buyer. So I want to go back real quick to this first quote that I brought up and how it talks about the 10-year Treasury yield rising. So why did they mention that and what does that mean? And so one important thing that we look at and that we know in the industry is that real estate mortgage rates go hand in hand with the 10-year Treasury yield. And so if we look at this graph here, this is actually going back almost 50 years for the 30-year fixed mortgage rate. And you can see that the 30-year fixed mortgage rate goes hand in hand with that 10-year Treasury rate as well. So the 10-year Treasury rate is an absolutely great indicator to monitor the ebbs and flows of interest rates as well. So as the 10-year Treasury rate goes, we expect mortgage pricing to go as well. And so this shows another example of that. This is just tracking the Treasury rate over the last several months and how it's changed. So you can kind of see that recent spike. That's where we're kind of getting that recent spike in mortgage rates as well. So I hope that answered some of your questions about interest rates and what's currently happening with interest rates in the real estate market. I hope it helps explain kind of some of the fears that buyers are having about what should I do? Should I jump in now? Should I wait? Is buying a home affordable? Is it not affordable? You know, ultimately, here's the thing. everybody's circumstances and situations is totally different. And there's lots of reasons that I think someone should rent an apartment or rent a home. But I also think there's a lot of reasons that people should consider purchasing a house if they're able. And one of the reasons people don't, I think the biggest reason is fear. So what we're really trying to do here is just create some clarity for you, give you the knowledge, give you the information so that hopefully you can build some confidence in making the next best decision for you. And if real estate is the best decision for you, I hope it is, taking the next steps that you need to take. Follow along. I love providing this information, expertise for you guys. And no matter where you're at in the process, maybe you're just a looky-loo and you just think it's interesting of what's happening in the real estate world right now. I love it. Follow along for the journey. Shoot me your questions. Shoot me your comments. I'd love to answer future questions from people that are watching this stuff online in my next video. So thanks for keeping it real estate with me today, guys.
Keep it real. I keep it real. I keep it real. Just keep it real.